Mutual funds as an investment vehicle are becoming popular by the day among both seasoned and newbie investors. Mutual funds are diversified in nature and, therefore, offer a lower risk of loss. This has paved the way for many people to invest in the open market. The mutual fund of today is a little bit different from the ancient one, thanks to the combination of several investment models. It is not very clear when the mutual fund was developed. However, there are stories that began in Europe and spread to the rest of the world. They give a rough idea. The most popular one is that of a Dutch merchant called Adrian van Ketwich. In 1774, he came up with the idea of getting modest investors to create a pool of investments. He began the Eendracht MAGT, translates to Unity Creates Strength. Unity Creates Strength offered small-time investors the opportunity to own a part of a diversified fund that consisted of income from securities and bonds. According to several experts, this was the first closed-end fund. Some see Ketwich as a hero because his idea came at a time when it was needed the most. The European financial market was troubled. To manage the risks of the fund, the investments were spread out to Southern and Central America, Russia, Sweden, Spain, Germany, Denmark, and Austria. In 1775, the shares were opened to Amsterdam. Two managers were responsible for making decisions concerning the portfolio's composition. The Unity Creates Strength Fund was liquidated in 1824. Mr. Van Ketwich's model inspired other groups. One of the groups that came up after this was the Voordelig and Voorzichtig, translates to profitable and prudent. This one was started by bankers from Utrecht, a Dutch town. Following the success of Unity, Mr. Van Ketwich created a second fund in 1779, Concordia res parve crescunt, translates to small matters grow by consent. It was different from Unity in that, portfolio managers were not limited to a list of securities that the fund was supposed to be made of. Managers had a little freedom to be flexible. This fund was successful, and investors received 87% of their initial investment when it was dissolved in 1893. In the 19th century, funds like the Small Matter began sprouting all over. London's first official investment fund was founded in the Foreign and Colonial Government Trust in 1868. The first investment fund for the United States was called Boston Personality Property and was founded in 1893. The structure of the modern-day mutual trust began developing in the 20s. The Massachusetts Investor Trust is probably the most notable one. It was an open-end capitalization fund, the first of its kind, and gave investors the freedom to buy back shares at the end of the day. Mutual funds mushroomed in America from the 50s to the 80s. That was when the index fund was formed. The first one was created in 1971 by John McQuown and William Faus. John Bogle created a more refined index fund in 1971. It is during this period, also, that the first reserve funds, money market fund and index investment trust were created. Mutual funds allow individual or small investors access to portfolios that are professionally managed. Every shareholder proportionally participates in the losses and gains of the fund. Shares mutual fund units can be redeemed or purchased at the current net asset value per share of the fund. To determine a Funds Nav, the total value of the securities is divided by the total amount of shares. A mutual fund is an actual company and an investment. When a mutual fund investor buys shares, he is buying a portion of the mutual fund company and its assets. Mutual funds collect pools of money from investors and use the money to purchase securities such as bonds and stocks. The performance of the securities bought determine the mutual fund company's value. Basically, when an investor is buying a mutual fund's share, they are buying its portfolio's performance. Mutual funds usually hold many different securities and, therefore, give their shareholders the benefit of diversification at a low price. These virtual companies purchase pools of bonds and/or stocks as advised by a fund manager and investment advisor. A board of directors is responsible for hiring a fund manager who is legally obligated to act in the best interest of the shareholders. Mutual fund companies typically do not hire many employees. The few employees often include an analyst, a fund accountant, and a compliance officers. The analyst performs market research and picks out investments. The fund accountant oversees calculating the NAV of the fund or its daily value. The compliance officer helps with government regulations. Many mutual funds are usually part of a larger investment company. Some of the biggest fund companies consisting of numerous separate mutual funds include Oppenheimer Funds, T. Rowe Price and Vanguard Group. Kinds of mutual funds: fixed income. This type of fund focuses on the investments that have a fixed rate of return. Index funds. An index fund manager purchases stocks that are like a major market index. Balanced funds. These invest in bonds and stocks to mitigate the risk. Other include funds of funds, target date funds, smart beta funds, alternative funds, equity funds, sector funds and money market funds. Mutual fund fees. These are classified into two: shareholder fees in form of redemption fees and commissions, and annual operating fees, annual percentage of funds under management. Advantages of mutual funds: diversification, economies of scale, easy access, professional management, individual-oriented, variety of styles. Disadvantages of mutual funds: fluctuating returns, cash. There should be enough money in liquid cash for ease of access, and idle cash is not productive. Costs: professional management comes at a cost. Diversification: lack of transparency, evaluating funds can be difficult.